The numbers, please. And here they are, the productivity numbers hitting the wires. Fourth quarter final, as Joe just said, 6.6% now replaces the 6.6%, so it stays exactly the same. And if we look at unit labor costs, our final look last time was 0.3. That now triples to 0.9. So that is the final fourth quarter read, up 0.9. And how does that compare? Listen, 6.6 productivity is awfully strong. The all-time high is 11%. That was in June of last year. And continuing claims come in at 215,000. 215,000. That is now down 17,000, although that 232,000 last week most likely is going to get revised here in a few seconds. And if we look at continuing claims, this is very odd. You don't often see exactly the same number twice in a row. 1,476,000 equaled our continuing claims last week, and it was most notable because you'd have to go back to that crazy year of 1970 to find a lower continuing claims number. And here the revisions are trickling in. Not much. 232 now becomes 233,000. So now we're down 18,000. And on continuing claims, 1,474,000 replaces 1,476,000. So we see that they're all getting kind of jumbled up there right around the 1970 comp. We see a 1.85 10-year. And I like the way Becky pointed out that we closed up, 14, 15 basis points yesterday. But that isn't even the aha moment. The aha moment was if you looked at December Fed Fund futures at the end of this year. So it's a logjam. Whenever a near month changes, it all rolls to every month downstream. It closed down 29.5 basis points, which means in a very simple way, we've added back in more than a quarter point just on yesterday's move alone. That brings December now to around 98, 55, 56. If you blur your eyes, we're basically looking at 6 quarter point of tightening, at least built on a very simple formula, just so we can continually assess how that's looking. And I caution viewers, we always make Fed Fund futures and their appropriate percentages into a science. It is certainly not a science. The nearby meetings are very accurate on their predictions when you get a couple weeks out like we are now for March. But the distant months can change very quickly. And my analogy is pick your favorite stock. Do you know where it closed 2 weeks ago, Thursday? Well, you can't trade it there anymore. Pretty much the same with Fed funds and their percentages. It's always on the move, and it's as good as the quote and the trade are the last time around. Joe, back to you.
Nice haircut, Rick.
All right.
I got a lollipop with this one.
Looks good.
Rick. People yell in my ear, Rick, when you said you're seeing it on the wires. It's the same as higher for you. All right, Steve Leisman, they do. They yell it in my. It's not just me. People yell it in my ear that they have access.
Voices in your head, dear.
Steve Leisman joins us now. That is a problem. Steve Leisman joins us now. Steve.
Joe, good morning. What can you say? But the job market's in a pretty good place. And it's good to be in a good place when you're entering the kind of uncertainty that we have now with both domestic and international economic developments. The 215 is a good number. It's heading down. The productivity number is a good number. We'll be hard pressed to hit that again in the first quarter. But if you looked at the Beige Book yesterday, which was really interesting, it said that there were worker scarcity, increasing compensation for workers, and especially, by the way, worker flexibility provided for low and moderate wage jobs, which is really interesting. So you go down the wage spectrum and employers have to offer more to get people to work. All of this is kind of like, well, we'll wait and see what happens with the impacts of the war. Ultimately, the thinking is that there's not a whole lot of economic trade between Ukraine and Russia and the United States. At the same time, there are key commodities that are going to be pushing up prices. And as Powell takes to the Hill today, one question I'd like to hear a senator ask is, Mr. Chairman, you're behind the curve here already. You need to do more. Doesn't the spike in oil prices and other commodities mean you have to go even faster? Powell's response has been, because of the war, we're going to go slow and steady and be nimble. But so I think what this means, Joe, is Rick is right that the market is predicting 6, I'd say 5.5 on the Fed funds. That said, I think the only thing that's certain is they're going to raise in March and probably the 2 meetings after that. After that, I think they take a step back and they look around and say, what's going on in this economy? How did this war affect the economy? How does the idea, by the way, they were on the other side of the Omicron wave and people look to be hiring again? How does that affect the economy? So I think June is a better time to say what's going to happen in December than March maybe.